Hello everyone, and welcome to this edition of Weekly Review. In the next few minutes, we'll take a look back at the most important financial news from last week and explore the key signals coming from global markets. First, let's look at the global economic outlook. In its latest World Economic Outlook report, the International Monetary Fund, IMF, lowered its forecast for global economic growth in 2026 to 3.1%. The report noted that while inflation has eased in some countries, overall interest rates remain elevated. Combined with rising geopolitical risks, both business investment and consumer spending have been affected. Markets generally believe that while the global economy continues to expand, growth momentum is clearly weakening. Now turning to the U.S. market. U.S. stocks delivered a strong performance last week, with both the S&P 500 and the Nasdaq reaching new record highs. The main driver behind the rally was a new round of corporate earnings that came in better than expected. In particular, solid profits from the technology and financial sectors helped boost investor confidence. Large technology companies remained the center of attention, while artificial intelligence-related stocks continued to attract strong capital inflows. However, some analysts warned that current U.S. equity valuations appear stretched, and if interest rates remain high for longer, the market could face correction pressure. Next, let's focus on interest rate policy. Markets remain divided over when the Federal Reserve will begin cutting rates. Although recent inflation data has declined from last year's peak, core price pressures have not fully disappeared, prompting officials to remain cautious. Investors currently expect that the Fed could begin cutting rates as early as the second half of this year, but the exact timing will depend on labor market conditions and inflation trends. In the energy market, international oil prices remained volatile last week. Supported by tensions in the Middle East and uncertainty surrounding supply, Brent crude stayed in the range of $80 to $85 per barrel. Higher oil prices not only increase transportation and production costs for businesses, but may also slow the pace of global disinflation, making central banks more conservative in their monetary policy decisions. In Asia, China continued rolling out pro-growth measures, with markets closely watching whether further property support policies and consumer stimulus plans can strengthen the economic recovery. Meanwhile, Japanese equities remained at elevated levels, while a weaker yen continued to affect import costs and the direction of monetary policy. In the banking sector, National Australia Bank stated that it would increase provisions for bad loans in response to rising risks from global economic uncertainty. This also reflects the cautious stance financial institutions are maintaining toward the future economic environment. To summarize, overall market sentiment last week was relatively optimistic, with funds continuing to flow into equities. However, three major risks remain in the background. First, slowing global economic growth. Second, the possibility of persistent or renewed inflation. And third, market volatility caused by geopolitical tensions. This week, investors will closely watch more corporate earnings reports, U.S. economic data, and the latest comments from major central bank officials, all of which could influence the next phase of market direction. That's all for this edition of Weekly Review. Thank you for watching, and we'll see you next week.